from the 100-day action plan. So I think it is more of continuity rather than any change that has been demonstrated through the allocation of ministries. You have broadly the same ministers continuing unfinished agenda of, Namo 2.0. So from that point of view, I think bullish stance continues. There is no reason to feel bearish after the recent bout of volatility. And I think multiples in India are not very cheap, but not very expensive either. For a 15% sort of a growth, I think valuations are going to sustain. So that's how things are. I think things pretty settled by now.
Top holdings include a lot of private banks. They have disappointed so far, with the exception of, let's say, ICICI Bank. But given that we are at a turn of growth, retail doing well, PSU stocks are now fairly priced, do you think now next 2-3 years could be dominated by private banks?
See, I think FY25 earnings growth is going to be led by technology, banks, oil and gas, and metals. And in that backdrop, and when we are talking about that 15% sort of a growth, and given the backdrop where financials are currently, they haven't really done too much in fiscal 24. I think there could be some catch-up game played by BFSI. And within that, obviously, private financials also has a role to play because they would have the highest weightage, so to speak. But what we need to watch out for is normalization of credit cost, and sooner or later you would have peaking out of cost of funds. And even in the fourth quarter, we did see that we didn't see too much of a dent in the margins. And credit growth in the system, would mean that a 15% sort of a loan growth is very much doable. So across the BFSI space, both the private sector and the PSU sector, you would have specific names where there is valuation comfort. So I think it's a pick and choose. Valuations are much more sanguine in the public sector banking space, and also quite reasonable even the private sector banking space. So from that point of view, I think BFSI stands in a sweet spot as we speak.
Manish, hi, morning. Exactly a month back, 17th May, when we were chatting, you were saying that PSUs are going to get massively re-rated after the election outcome overhang is done away with. Do you think it's going to be a lot more selective, though, and not such a blanket PSU call, which has been the case and held out very true for almost last 2 years, if not year and a half?
No, I don't think so. I think it's a reiteration of the fact that there is wealth that is going to get created in the PSU space over the medium to long term. I think it goes without saying that obviously market rewards growth, and obviously the margin of safety is there when multiples are lower. So I think given where valuations of the private sector units are, the capex continuity, particularly in railways, defense, power, the private counterparts are actually trading at significantly higher valuations. And when you have a situation when, the internal machinery in the PSUs is being geared up for growth and creation of market cap and rewarding shareholders and all stakeholders, I think there is a case for a re-rating in the PSU space, even from these levels. Because, when you have a growth and valuations and dividend yield comfort, I mean, that's the best recipe for value investing, isn't it? And that's what PSUs as a whole are presenting today before you. So I would think that PSUs will continue to create wealth for investors even now.
But Manish, PSUs ex banks is a very, very large umbrella that we are talking about. Where is it that you see both the growth runway as well as somewhat of a valuation comfort?
So you talk about the power sector as a whole, the monopolies. You have significant monopolies. The power financiers. You come to the logistics space, the largest container company in India moving through rail. You have oil marketing companies where, fuel demand is not going to peak before 2030 in terms of volumes. Gross refining margins are pretty good. and marketing margins are also elevated. For the last 2 years, we haven't seen any price increase. And these companies still today are available at 6 to 7% dividend yield. I mean, 4 to 5 prices to earning multiples. So I would believe that monopolistic organizations, we talk about defense, you have the three largest companies. When the government is focusing on indigenization, Atmanirbhar, you have a long runway for growth for the next 5, 7 years, 10 years. Because the export story also out here is just starting. So I think monopolistic organizations in the PSU space offers you growth at very, very reasonable valuations and very good dividend. I mean, that I think would offer a high margin of safety.
Uh, you bought into Zomato, but Zomato now is a market cap of 2 lakh crore, almost 2 lakh crore. That makes it in the top 50 companies in terms of market cap. What is the right way to look at a company like Zomato now from the valuation lens? Because survival has happened, turnaround has happened, growth has happened, acquisition has happened. Now it's back to brass tacks, which is let's value this business, which is a high growth business based on either cash flow or on other multiples.
So if things go as is being projected, minus the competition scare, the very recent competition scare coming in, that they are going to disrupt business for Zomato as a whole, I would believe that profit numbers are going to surprise in 2026. The story was good in the food delivery space. Now it's the quick commerce which is keeping expectations quite elevated. So I think when you have a 70-80% GMV growth, particularly so on the quick commerce side, and the path to profitability out here is very visible now. You at 2 lakh crores, when your growth is 60-70% in the quick commerce space and your food delivery is 15-20%, they have already articulated doubling the number of stores to 1,000 within the next 3 years. And then when you compare these with other, developed countries, similar businesses, they're trading at some 50-60 billion dollars GMV. I mean, and this is basically a business about habit formation, can't be reversed very quickly. And mind you, it's a very high entry barrier business. Just because you want to burn a lot of cash, you would not be able to take market share because it's a top of the mind recall. As of now, it's still a duopoly where the second incumbent is not keeping up with the pace at which Zomato is doing. So from that point of view, I think the story remains intact in terms of profitability. What is to be watched out for is the pace of opening up of the store, because that will give you a surety about the GMV on the quick commerce side. And food delivery, how it trickles down into total annual transacting customers into monthly and weekly, and how Zomato Gold plays out in terms of driving that sales would be the matrices to watch out for. All in all, as long as the growth continues, I don't think there is any reason to get worried about Zomato just yet. I mean, of course, competition is something which we need to watch out for, and it's a very strong competitor who has announced intentions to get into the quick commerce and the food delivery space. But it's a high entry barrier business, I would believe. Not so easy to get in and take market share.
Other than the Zomato, Manish, where is it that you find some of these businesses with a moat around them?
So consumer discretionary, I think, will be the area to watch out for from the next 5 year point of view. And obviously, there would be a balance between consumption and investment. Right now, the valuations are somewhat conducive for some of the beaten down sectors in the consumer discretionary space. A case in point would be QSRs, which have languished around for the last 2-3 years. I think when there is welfare scheme, when there's money that is thrown in this space, you would see the volume uptick, which everybody has been aspiring for. And then you would have the durables, you would have, outsourcing of electronic manufacturing. So basically, it's all about growth and what valuations you're getting. I mean, there is broad-based growth, so to speak. It's individual stock picking. whether it be in the pharmaceutical space, whether it be in the consumer discretionary space, or whether it is in the PSUs or industrials, etc. And there's no single pocket which is left which wouldn't see growth, according to me, in Modi 3.0. But one needs to be mindful of valuations. Some of the names would be very heavy in terms of valuations from a near-term point of view, but that's how it is, and one needs to be stock picking as we move.
So, Manish, is there anything else apart from OMCs which looks interesting in terms of a combination of earnings and P multiple both can expand?
Yeah, I mean, if you're talking about PSUs, the entire power sector space, you have tremendous growth for the next 4 5 years, renewables, thermal, across the value chain. And obviously, some of the PSUs in this space are trading at significant discount valuations to counterparts in the private sector space. I mean, this bigger gap just can't remain. And if an Indian needs to grow at 6.5%, we need to fix our energy security. And obviously, a lot of impetus on renewables and the entire value chain. So power is one space where there's valuation comfort vis-a-vis the growth. I would believe some of the durables, consumer durables, would see some significant growth going forward. I'm quite bullish on the premium motorcycle space. I think out here, after a long hiatus, you're likely to see growth. And, valuations out here in the motorcycle space is still very, very favorable. Not yet caught up with fancy valuations of some of the counterparts. But that's how I would look at some of these names.
Okay. And what you said that FY25 numbers will see a recovery because of IT. Did I hear you right?
Yes.
IT 4 से 5% growth है उधर तो.
नहीं, 4 से 5% growth जरूर है, but you have to see the book to bill. Macro headwinds, etc., translated into orders, but no execution. So the belief is if there is a book, it needs to be executed. And fiscal 25 is likely to be much better than fiscal 24 because you can't keep on the book forever, right? And macro headwinds seem to be abating. I think the key thing to watch out here is the hiring. Hiring will give you that execution is around the corner. So you could debate whether it is second half fiscal 25 or early 26. That's a given, but valuations have corrected 25-30%. You have an AI overhang on the hiring side and productivity gains, whether it results into billing. All of that will manifest into what you're going to buy in the IT space. But definitely, IT in fiscal 25 looks to be doing much better in terms of numbers than when you compare it to FY24. It's going to be one of the drivers of earnings for fiscal 24.
Okay, Manish, great to have you on the show. Thank you so much for taking the time out and chatting with us today. Okay, let's move on. Let's just see where the market has